The Bank of Canada holding its overnight rate at 5%. But the bank isn't ruling out future hikes because price pressures in our country remain high.
We held our policy rate steady today because monetary policy is working to cool the economy and relieve price pressures, and we wanted to give it time to do its job. But further easing in inflation is likely to be slow, and inflationary risks have increased.
The bank says it's still concerned progress towards price stability remains low and inflationary risks remain high. For more on this, I'm joined by Jean-Paul Lam. He's the former Assistant Chief Economist at the Bank of Canada and a Professor of Economics at the University of Waterloo. Jean-Paul, thanks for speaking with us.
Thanks for having me, Matt.
Did the bank make the right decision today?
I think so. Looking at the data we've received since their last decision, what we've seen is inflation has come down, albeit very little. But more importantly, what we are seeing is a sharp slowdown in the economy. GDP numbers are flat. Basically, there's no growth, and that coming from reduced consumption from consumers and slower business investment. So based on the assessment of demand at home and global demand as well for Canadian exports, I think, and also the progress that we're making on inflation, I think they made the right decision today.
What does this mean for Canadians struggling to pay for food and rent?
I think in the short run, it implies that the fight for inflation will continue. So we haven't won that battle yet. So prices of some goods will continue to stay high. I think what Canadians have to realize is that the Bank of Canada targets inflation, which is the growth rate of prices. So although the growth rate of prices has slowed down significantly over the last 6 months, the level of prices remain elevated.
How will this impact mortgage costs?
So mortgage costs are mostly linked with the 5-year government bond yield in Canada. That's because the most popular type of mortgages are fixed mortgage types in Canada, and the term is 5 years. What we've seen the last couple of months, especially in the US, we've seen the yield, the rate on these 5-year government bonds increase fairly significantly, and they've reach more than 5% in the US, which we haven't seen in a long time. And that's because of investors' concern regarding long-term inflation and the pace at which inflation is coming down. So if we continue to see the 5-year government bond yield in Canada and the US continue to rise, and even if the bank rate stays at 5% where it is right now, mortgage costs for most Canadians who have to renew their mortgage will continue to increase.
Today's quarterly monetary report from the bank forecasts slower economic growth than expected and higher inflation in the short run. Should Canadians be concerned?
We should be concerned. I think when we look at what the Bank of Canada has done since 2021, it has increased, as we know, interest rates significantly. And that's because inflation increased much more on their target of 2%. Normally, with the rate of increase and the pace at which we saw the rate increases, inflation would have come down to 2%. But inflation remains stubbornly high, which means two things. If we have external factors that affects the Bank of Canada's forecast, such as uncertainty, geopolitical uncertainty in the Middle East that increases oil prices, that adds pressure to inflation, then we will continue to resume their increases in interest rate. And the second thing is, I've been saying that for a long time, even if inflation has come down, the Bank of Canada has signaled that its current stance on monetary policy and the current level of interest rate will stay high for a long period of time. So even if Canadians see inflation going back to the 2% target, it doesn't mean that interest rate will go back to the level we were accustomed to before COVID. Interest rate might stay at their level right now for a significantly longer period of time than people are thinking in Canada.
That's Jean-Paul Lam. He's the former Assistant Chief Economist at the Bank of Canada and a Professor of Economics at the University of Waterloo. Jean-Paul, thanks for your time.
Thank you for having me, man.